Welcome to the first episode of A Quest for Twice in 2023. Today is January 10th. Happy New Year to everyone. As I planned in my year-end review last year, I'm going to do a deep dive on Walker Dunlop because I think it will outperform the market regardless if it's an inflationary or recessionary environment in this year. So Walker Dunlop is a commercial brokerage company. It gets a cut of the transactions it brokers, and it focuses on commercial real estate, especially multi-family housing, i.e. apartments. So to understand the health of its business, the most important metric is its transaction volume. So we can see in this graph that its transaction volume has increased rapidly in the last 11 years in a CAGR of 32%. Because of the rapid rising interest rate environment in 2022, it'll be interesting to see if its transaction volume in 2022 will match or exceed the volume in 2021. Besides getting commission from the transactions Walker Dunlop brokers, it often retains the right to service the multifamily mortgages. And that's valuable, as I will discuss later. I also want to point out that most of the transaction volume for Walker Dunlop comes from mortgage transactions, i.e. a broker a loan from a lender to the borrower. However, in recent years, Walker Dunlop started to really grow its property sales volume, so getting commission from sales of the property. So we can see from this chart, its sales volume has grown very rapidly with a CAGR of 50% in the last 5 years. I think the key reason is property sale and property financing are synergistic. So Walker Dunlop could leverage its vast relationship and channels from financing for its property sales brokers. So in the last trailing 12 months, its property sales of 25.7 billion exceeded the 2021 annual sale of 19 billion. So I believe in 2022, when the fourth quarter results come in, its sales volume in 2022 will be over $25 billion. However, there is a downside of being a transaction platform company. Let's look at the top chart. The red line is the revenue from Walker Dunlop's capital market segment. Basically, that's driven by the cut of the transactions it brokered, either in financing or in sales. So we can see that its revenue has a lot of variations in the last 8 quarters. It grew from $150 million in first quarter 2021 to about $200 million in third quarter 2022, with a peak over $250 million in the 4Q 2021 and a low point less than $180 million in the first quarter of 2022. So a lot of variabilities. That variability is driven by the variability in transaction volume. That's plotted as the yellow columns in this chart. We could see the transaction volume peaked in 4Q 2021 and had a big dip in the first quarter 2022, then rebounded in the second quarter before dip down again in the third quarter of 2022. Besides the seasonal impact on transaction volume, interest rate has a very big impact. That's why the third quarter of last year had the second lowest transaction volume because of the rapid rising interest rate. I also want to note that the revenue also includes the impact of mortgage service right revenue, as I mentioned earlier. So once Walker Dunlop retains the right of MSR, it's capitalized on its book, and the incremental MSR is counted as revenue. So in order to support the large volume growth in the past, Walker Dunlop increased its cost, especially personnel cost, significantly in the last several quarters. So that's why when volume dropped in the third quarter last year, its EBITDA basically reached zero. That's because its third quarter personnel cost roughly equals to the third quarter revenue excluding MSR, which is non-cash revenue. So we can see that this capital market segment business is very volatile, and especially its EBITDA is quite volatile because it has been also affected by the rapid growth in the number of brokers and support personnel Walker Dunlop hired to support its growth. As I shown in previous slide, it had a huge growth in property sales volume as well as the overall transaction volume. So in the trailing 12 months, its EBITDA was $66 million versus $90 million in 2021. However, if interest rate stabilizes, I believe the transaction volume should rebound, regardless of how the economic environment will be. Let's say if the economy still suffers inflation, but the Fed's interest rate is stable, then multifamily assets should provide protection against inflation because landlords could reset the rent periodically and keeping up the rent with inflation. On the other hand, if the economy enters a recession, people still have to live somewhere. So most of the people will still have jobs because the Fed will not want to really wreck the economy severely. Therefore, most of the apartments will still be occupied and provide a steady income stream for the apartment landlords. Therefore, I believe the transaction volume will rebound once the interest rates stabilize. There is another reason to believe transaction volume for Walker Dunlop will rebound. That is, there is a tailwind of multifamily loan maturities in the coming 2 years. So as shown in the bottom right, we can see the amount of loan maturities since 2018 has been increasing, and with 17% increase from 2021 to 2022. Then there is a 50% increase from 2022 to 2023 before another big jump up in 2024. So since those loans will be maturing, then they either have to be refinanced or have to be sold. Then the new owners will likely finance the new purchases. Earlier, I mentioned the mortgage service right is an asset because the mortgage service fee is about 0.247% of the loan balance. So Walker Dunlop could generate the revenue from mortgage service right as an asset. And the future service fee is secured when a loan is added to its servicing portfolio. We can see from the chart that Walker Dunlop has been increasing its MSR steadily from $63 billion in 2016 to over $115 billion in 2021. In 2022, the growth has decelerated because of the rising interest rate environment I mentioned. So as of end of September last year, its MSR portfolio was about $121 billion. W&D has a target for MSR to reach over $160 billion in 2025. With its rapid growing sales and financing transactions, I think it has a good chance to reach that target by keeping its past momentum once the interest rate stabilizes. We can see that the MSR asset is valuable because in 2021, W&D generated over $278 million of servicing fee. That's almost double from the servicing fee in 2016 because of the increase in the MSR asset. So is Walker Dunlop in danger if the transaction volume doesn't rebound for several more quarters? The answer is no, because of its service and asset management segment. So in this chart, I show the revenue from the SAM segment for the last 7 quarters. The revenue stepped up after acquiring Align Capital and Zelman and Associates in the fourth quarter of 2021. The high revenue in the fourth quarter 2021 appears to be a fluke. However, I don't have detailed information because Walker Dunlop hasn't provided that information. That information will come out once Walker Dunlop reports its earnings for the 4Q 2022, which will also include the segment information for 4Q 2021. So we can see from this chart that its revenue, EBITDA, and profit margin were fairly stable in the last 2 quarters after the M&A activities in 2021 and early 2022. The main impact from rising interest rate is $5 million higher interest income in the second quarter of 2022 and $15 million higher interest income in the third quarter of last year. So if we annualize the results from third quarter and second quarter of last year, we get a run rate annual EBITDA of more than $400 million. Its corporate annual EBITDA sink is $130 million because the corporate doesn't generate the revenue. It's really a cost center. So the small chart on the top right shows the impact of a rising interest rate. So if the interest rate is very low, like in 2021, its escrow interest income basically matches its corporate interest expense. When the interest rate rose, like in fiscal year 2022, then the interest income exceeded its corporate interest expense, and it's forecasted that the income will significantly exceed its corporate interest expense in 2023. So I believe it's best to look at the EBITDA as a cash proxy and evaluating the valuation level of Walker Dunlop using EV over EBITDA ratio. So at $84 per share, its EV over EBITDA for 2022 is about 12.7. That's really cheap considering that its EBITDA is well supported by its service segment, and that part is very safe and secure. Although its capital market segment didn't make any EBITDA in the third quarter last year, but that's because of the high and fast rising interest rate environment depressed the transaction volume. In addition, Walker Dunlop had increased its personnel cost in the last several quarters to support its past and future growth. So I do believe that its capital market will be EBITDA positive again once the transaction volume rebounds. Datto grew its 2023 EBITDA from 2022 level and support my thesis that Walker Dunlop is a growth company with a very attractive valuation level. As I noted in the past, Walker Dunlop has been using its cash wisely, including buyback, dividend, and acquisitions. Its recent acquisition of Align Capital and Zelman revenue were both on track based on the model at the time of the acquisition that demonstrated its prudent use of capital buying into businesses that had a very steady EBITDA and revenue, were not subject to the transaction volume volatility. So I plan to buy more Walker Dunlop despite I have about 4% of my portfolio in this company already. This concludes this first episode of Quest for Twice in 2023. Until next time, happy investing.